company is a C corporation, and in that case, you're almost always going to have a stock purchase because for tax reasons, which I won't go into, a lot of Mark Furman and other people can go into the tax analysis in deeper detail. Basically, you get an effective tax rate of about 70% if you sell the assets of a C corp, right, unless you have what are referred to as net operating losses, and I'm now walking into Mark's territory, and I won't do that. Because in my territory, which I want to talk about, is what is involved with the stock purchase agreement. And this is very interesting because while we do, 11 or 12 of these a year, for most business owners, they do one in their lifetime.
Right.
So it's a very new thing for them. The stock purchase agreement or the asset purchase agreement is the document under which you are actually selling your company. It is composed almost always of three parts. The first part is what is the structure and the purchase price for the transaction. For want of a better phrase, I'm buying all your blank assets, I'm assuming the Y liabilities, and I'm going to pay you X dollars. In a stock purchase agreement, I'm buying all the stock of the company, and I'm paying you X dollars. It's where you're going to put in any of the earnouts that we discussed in the earlier section, any of the contingency payments that we talked about, and how much is being paid down, and when is it going to be paid. On occasion, you have something called a net worth covenant or adjustment, which is a provision that basically says, listen, I'm buying the company, I'm expecting there to be a zero balance sheet at the end, meaning that the assets and the liabilities basically equal each other. If that's not the case, there's an adjustment to the purchase price which is done at the closing.